What's the most frustrating part of trading breakouts? It's the fake breakouts. You jump into a move only to see it reverse, stopping you out for a loss. But what if you could get paid while you wait for the real move to happen? Well, in this video, our head of options trading teaches you what could possibly be for you the best option strategy for breakouts, allowing you to capture cash flow first and then big upside after the breakout is confirmed. I'm Mike Bellafiore, and we're one of the top proprietary trading firms in the US with numerous 7 and even 8-figure per year traders. We hope you agree you have found the right place to learn.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And as most traders are aware, the market absolutely loved the remarks delivered by Fed Chairman Powell at Jackson Hole, where he strongly hinted that the Fed was seriously contemplating beginning the process of easing monetary policy and cutting interest rates. And the broad-based index with the biggest reaction was actually the Russell 2000 index, which uses the ticker symbol RUT, the index of small cap stocks, which had a flat out melt up, rallying 3.8% in that single day. That's a huge move for an index in one day, blasting past its high for the year and closing at 2361.95. And so a trader might well think that this is the beginning of a breakout in small cap stocks, as they're quite sensitive to interest rate movements. And if the Fed is about to commence a period of rate cutting, that's historically proven to be very bullish for small cap stocks in general. And so when options traders see a situation like this developing, there's a particular really bullish option strategy that's often chosen to exploit breakouts. And we're going to be sharing that strategy with you in today's video. So if you're interested in an option strategy that can work beautifully in a breakout situation like the kind that may possibly be developing the Russell 2000 index, then I'd stick around, because I think you're going to be surprised at just how powerful it can be. Now, before we get into the strategy that I'm going to be covering in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. So if you click the video appearing on your screen right now, it will lay the groundwork for you to understand what we're covering in today's video. And then you can finish up that video and watch the rest of this video after that. Okay, so to illustrate how this strategy works, we're going to head back to a similar situation earlier this year when the administration announced that it was planning to extend the deadline for tariff negotiations 90 days to give countries more time to strike trade deals with the U.S., which caused a huge rally on April 9th and began the beginning of a powerful market bounce that has honestly continued through the summer. And so a few weeks later, on April 23rd, as you can see, the Russell 2000 index gapped up 2.5% to 1938, although gave some of that back during the market session, closing at 1919.14. And so let's say at the end of that day, we pulled up an options chain expiring a little less than 3 months later on Friday, July 18th. And on the call side of the options chain, we bought a call located at the 2010 strike price, about 90 points above the index's closing price, with the call option trading for 63.40. And then simultaneously, we head down to the put side of the chain and sell a put right below where the index is trading, the 1910 put, for a price of 92.40, while simultaneously buying the 1650 put for a price of 25.05. forming what options traders refer to as a put credit spread on the put side of the options chain. And so when we do this, buying a call on the same options chain where we sell a put credit spread, when we do that, we're entering into what options traders refer to as a modified version of the risk reversal trade, which is a very bullish trade, but it has a secret feature that will surprise you, and we'll cover that a little bit later in the video. It's very important to understand what's happened here from a cash flow standpoint, because that's critical to the intriguing features of this trade. You see, starting with the 1910 put that we sold, we received the price of 92.40 for selling that put. But remember, index options pay off at a rate of $100 per point, that the index closes below the put strike price when it expires. And so you multiply that price by 100, resulting in total cash received for selling this put of 92.40. But then you spend most of that buying the 1650 put for protection for 25.05 and paying for that call, of course, at 2010 for 63.40. But when you net it all down, you'll see that you get some change back and you end up with positive cash flow of $395. Now, this positive cash flow was absolutely intentional on our part in this example for reasons you're going to be understanding a little bit later. Please also note that your broker will require you to have at least $25,605 in your account to enter this trade, which is the worst case scenario loss should the breakout prediction be really wrong and the market were instead to sell off hard. And so you might ask exactly, why is this considered a bullish trade? Well, let's look at what happens if you're right. And the index does indeed continue to rally after bouncing as a result of the administration's softening of its tariff stance. So let's move to the day this trade expired on July 18th. And as you can see, the index did indeed continue to rally, with the index of small cap stocks, the RUT, closing at 2240.01 on the day the trade expired. And so let's take a look at the impact that this had on our trade. You see, now that the July 18th options chain is expired, the options market can assign a final value to each of the options that comprise our trade. So let's take that one by one. So starting with the initial cash we got, remember, we keep that, and that's a permanent component of the profits of this options trade. So we'll start with that $395 that we collected at the beginning. Next, we'll focus on the call that we bought. Well, the index closed at 2240.01. So with call options, the way that you determine their final value is to subtract the index's closing price from the call strike price, which in this case results in 230.01. And then you multiply that result by 100 because index options pay off at $100 per point. And so we add to the initial cash flow the $23,001 in value of the call we bought at expiration. And then the rest is easy because they are puts. And the index closed more than 330 points above the short put strike price of 1910 and more than 590 points above the long put strike price of 1650. So neither of those options has any value at expiration. They go out worthless, meaning that the trade profit is $23,396, which is over a 91% return in less than 3 months on the required capital of $25,605. And so if you think about it from a cash flow standpoint, we never really had any outflow of cash from our account at all during the entirety of the trade, yet we made over $23,000 on the trade. And so instead of tying up cash, we actually received a small amount of cash, meaning that we could have, for example, invested our cash in a money market fund, which these days is paying over 4% while we wait for the trade to resolve, which of course effectively increases our profits further. Now, before we conclude, I did want to point out something really interesting that you might have missed as we went through this trade. You see, there were only ever really 3 potential outcomes for this trade. The first outcome is the one we just shared with you, and of course that's the best outcome when the puts expire worthless, while the call can be cashed in for a lot of value, and that of course only happens if the index closes above 2010 at expiration. But have you considered the second outcome? Suppose the index closed in that 100-point range between 1910 and 2010. Well, in that case, the call expires worthless because the closing price is not higher than 2010, which would have given the calls some value. Nor, though, is the price below 1910, which would have given at least the 1910 puts and possibly the 1650 puts value. So, in this example, in this range, all 3 options expire worthless, and your profit is that $395, the amount you collected at the beginning. And finally, the third outcome, of course, is that the RUT closes below 1910, at which point you'd begin to lose money on the trade if the payoff on the 1910 put exceeded the cash flow you received initially. So in other words, even if the index just chopped around and flatlined, you would have made money. So there's a built-in profit right from the start of this trade, as long as you weren't completely wrong and the index went down significantly. Even if the index literally did nothing and closed at the exact same price it was at when you opened the trade, you will make something on this trade, that initial cash flow. And so what I'd like you to take away from today's video is that option strategies provide you with the unique opportunity to make money on a breakout, even if the breakout ends up fizzling out at the end of the day. But at the same time, if the breakout follows through, you can end up with a boatload of profit without ever actually experiencing any cash outflow through the entire trade, which then opens up the possibility that you can invest that cash in short-term instruments like money market funds while you wait for the outcome of the trade to materialize, which in some cases can result in spectacular outcomes like the one we just covered. The modified risk reversal is a powerful options trade when deployed under the right circumstances.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.